Hi, and welcome to Macro Wednesday, where we talk macro, try to make sense to markets that, they don't really make any sense, but more importantly, answer your questions so we can become better investors. I'm your host, Steven Van Metre, and thanks for joining me today. Have I got a great show lined up for you? Well, I want to come back to the Monday episode, and the feedback was really good, and I appreciate that. In fact, the feedback I got was you really weren't political at all, and okay, I appreciate that because I don't want this to become a political show. I think you've got plenty of other outlets if you want to listen to politics. But in the world of macro, you have to take politics into play, especially in an election year. We have a president. They're up for election. It happens to be a Republican. Wouldn't matter if it's Democrat. They're still up for election, and they are a variable. And it just so happens the president we have is a pretty big variable in the game because he is known for talking markets up, and we know he really cares about equity prices. So he is a variable, and he does come into play because what is really macro? Is it just looking at the data? Is it looking at charts? No, it's a risk reduction strategy that if you look at the data and look at the charts, you can invest over longer periods of time and reduce your risk. That's what macro is. And you have to take that into account in an election year. Because what is the data telling us right now? The bond market is telling us we're facing an insolvency event. That's what it's telling us. That all this liquidity on the fiscal side, on the monetary side, did nothing. And it's telling us something worse is to come. Then we go look at the banks. The bank earnings came out and they were all right. I mean, some of them are so far been better than others. But I don't care about their earnings data because the market doesn't care about the earnings data. What do I want to know about the banks? Oh, why are their loan loss reserves going up like their stock prices, like stock prices? Man, they're raising their loan loss reserves like it's 2008 and 9 again. They're concerned. And how about their bond portfolio? Man, they're buying so many bonds. Boom, they're bullish on the bond market. Why? Because they know bad things are coming. So I don't care so much about their earnings. I'm looking, I'm watching their feet. What are they doing? And they're telling us bad things are coming. And then I look at the economic data and I'm like, that's not good. And I look at the state of the virus moving around the country. That's not good. And it kind of makes me wonder, from a macro perspective, what is going to happen this year? So I do think before the election, we see a big drop in equity prices. The question is, and I saw some of you in the comments say, no, Steve's wrong, and they're going to stay down. Look, I could be wrong, but that's the whole fun of being in macro. You have to look out. Macro is not a microscope; it's a telescope. So you look out and say, okay, if the market is indeed telling us there's an insolvency event coming, and stock prices are going down. From a macro perspective, is it a buying opportunity or not? I don't know. We'll see when we get there. I have a hunch that it will be. And my hunch stems from, not that I think there'll be a bunch of retail money coming in, but the market has actually changed since the great financial crisis. I managed money before then. I was in the game before then. And I can tell you, we did not have these black box computer algorithms that were reading the news and, boosting stock prices up or down or commodity prices up or down in a fraction of a second. Didn't have that. We didn't have high frequency trading that was pushing order flow. And if there were a bunch of buyers, they're marking prices up. Or if there was a bunch of sellers, they're marking it down. We didn't have that. And today we have so much money flowing through high frequency trading algorithms because people want no trade fees. Well, nothing's for free, so we get to pay a marked up price. And yet people are cool with that. In fact, I have an idea to solve the inflation problem. You're going to love this. I think the whole country, whole world should go, all pricing should be routed through high frequency traders, right? Because people seem to be okay paying more for a share of stock than the person before them. Now, my dad raised me to pay the least price for whatever I'm buying whenever possible. But today, if someone pays more for a stock, it's cool as long as the person after them pays more than the person after them. They don't care. So why shouldn't all, say, real estate transactions be routed through high-frequency trading? So that way, housing prices automatically kind of go up because the next person buys more. Maybe when you go to the store, how about this? What if you go to a fast food restaurant, right? And you're in line getting the drive-through, and everybody in line in front of you pays more than the next person. Man, we'd have inflation. Yeah, that's probably a terrible idea. But it seems to be that people are okay with this. But remember, the knife cuts both directions. So from a macro perspective, I have to look. Maybe you agree with me, maybe you don't. But that's the whole point of the show, is to get you to think long term. What could happen? Because when that event comes, when that market drop does come, when yields price in that insolvency event and stocks come down, what are you going to do? Are you a buyer? Are you going to go to your data and look? I mean, are you an automatic buyer? Are you a buyer on contingent on data? Are you still on the sidelines? Are you looking at something else? What are you doing from a macro perspective? Because that's what really macro is. This show isn't, macro in Steve's way. It isn't Steve Talks' book, although, kind of both of those. In fact, it's a lot of that, right? I mean, where I give you my interpretation of macro. But what do? I show you where to get the data. I didn't have that luxury when I started doing this. I had to go figure out, because people would hide it, and I had to go dig through it and form my own opinions and read what other people were saying and decide if they're right or wrong. But you get to do the same thing. And that's what's really powerful. And that's what's cool about this show. The other cool thing is I love making predictions. And some of you are like, oh man, that's kind of weird. I didn't see this coming. Were you doing this because you felt pressured to come out and make that prediction? No. I love doing it. And the reason I like doing it so much is probably over a decade ago, there was a brief time I worked at another securities firm, and one of the principal owners who did the radio show for the firm that I got to be on from time to time, made it very clear to me when I made a prediction on the air that I was never to make a prediction ever, because it's career suicide. Bring it on. And after that, I'm like, man, I love making predictions because it's fun. Sometimes you're right, sometimes you're wrong, but it challenges you to think through your narrative. And then it gets you prepared for when that event comes, what are you going to do to help make that investment decision? Because that's what it's all about, right? Macro says you go from one cycle to the next, you make your money, and hopefully you catch the next wave. And if you miss one, remember, it's like waiting for the bus or a train. You miss a bus, it's okay. Don't panic. Don't play chase. Don't go running down the street after the thing. Look for another bus. Maybe it's not going the direction you thought, but maybe there's an opportunity there. Do your research, see what's going on. That's macro. Now, I also have a show update. There's going to be a format change. I'll get to that a little bit later when we get to the Q&A. Let's dig into the data and go back to Monday and see what's going on here. So on Monday evening, we got the export and import data out of China. And on a year-over-year basis in June, exports increased from minus 3.3 to 0.5, and imports went from minus 16.7 to 2.7%. All that to say is you'd have to say, wow, massive recovery. Here's the catch. A year ago in June, they were negative. There's like a soft recession going on. So these numbers, they're better, and I don't want to discount them. They're just not lights out better. They're not enough for me to be terribly excited about. Let's key into the Chinese export data. Since I haven't looked at this, we can maybe make a fool out of myself simultaneously. And we can see it's just not posting really super high numbers compared to where China needs to be. I mean, China needs to be running, exports need to be up in the 20-some% range, and this could be the beginning. Could be. We'll just have to see how it goes. Let's move into Tuesday. There's a lot of May data here, and I'm not really interested. I mean, the May data all around the world was bad. German CPI. So we've seen CPI start to tick up slightly. We're going to take a look at that compared to the money multiplier here shortly. But in Germany, it went from 0.6 to 0.9% in June, so a little uptick on a year-over-year basis. How about in Spain? We see CPI improve from minus 0.9 to minus 0.3 on a year-over-year basis in June. Economic sentiment out of Germany fell. Current conditions also fell. That's not too good. At least maybe inflation is ticking up, but outlook is not. Let's move into yesterday's data, the CPI data. So what do we have on a year-over-year basis? The consumer price index in June went from 0.1 to 0.6%, so an increase, definitely a small increase in inflation. Stripping out food and energy, which is your core CPI, was flat at 1.2%. Let's move on. The market now you would have reacted to that, and it didn't. And let's go look before we move on. Here's the money multiplier in blue, a good proxy for short-term inflation. Here's the consumer price index, and now I'll zoom in, and you can see an uptick in the money multiplier led to a small uptick in the consumer price index. So the question then is the trend in the money multiplier still bullish? Is it going to head up, or we're going to see it head down? Now remember, the bottom, the denominator of the money multiplier is the monetary base, which the Fed has influence over by quantitative easing. And the reason the monetary base has dropped was because a lot of these swap lines that the Fed was running have been paid off and are kind of back at zero. Has the Fed stopped doing QE? No. Powell has said he's maintaining a minimum $120 billion a month floor. Well, obviously that is subject to meeting to meeting, so we'll see what, in the next meeting if there's a change, but it seems highly unlikely. And so that means that as the Fed continues to buy $120 billion a month, they're going to push that back, the monetary base up, and that should be bearish for the money multiplier and then bring inflation down. So for those people who believe hyperinflation or high rates of inflation are coming, the money multiplier is going to give you that signal, and it's not going to be perfect month to month, but you're going to get that signal from the money multiplier. Now let's come back to the Red Book retail sales. These are same store. These are not online sales, so keep that in mind. On a month-over-month basis, last week it jumped to 3% from minus 0.6 a month before. Now I'm kind of wondering, because this was after a holiday weekend of July 4th, are people hitting the stores really heavy? And I heard people on Twitter talking about, hey man, the Costco's packed, and someone's front. Costco's always packed. I don't know what Costco you're at, but mine's always busy. Well, apparently stores were busier than normal, and people are buying more. And I'm kind of wondering, and I don't know if the answer is, are people realizing that perhaps that those extra checks are going away, and maybe their jobs are going away when the PPP loan money starts to dry up early next month, and they're stocking up on food stuff, or maybe they're out buying computers for the kids because they're going to have to be at home for school potentially. I don't know. So we'll see if it's a one-off event or not. But looking at the year-over-year retail sales, they went from minus 6.9% to minus 5.5%. So small improvement. But again, you got to look at the big picture. This is recessionary territory. I mean, back in 2009, same-store sales got, I can't get the mouse to hit it, but around just under 5%. We're sitting there now. So this is not spelling a good, or signaling a good, spelling doesn't spell anything. It's not signaling a good story for brick and mortar retailers. Let's move on to South Korea export price index. So again, if you're looking for inflation, you're going to look at the import-export data and the pricing data. So this is price. So export prices. South Korea went from minus 8.4, slight improvement, to minus 6. So they're still exporting deflation. How about import prices? From minus 13, now minus 7.3. They're importing deflation. So no sign of inflation in South Korea. Exports, preliminary exports on a year-over-year basis, minus 10.9% in June, minus 11.2% for imports. So no signs of inflation coming out of South Korea or demand. Moving into Wednesday, today's data, Great Britain CPI improved from 0.5 to 0.6. So we'll see some consistency in CPIs around the world, ticking up slightly. The money multiplier being our cue there. Looking at mortgage applications, rose to 5.1% from 2.2 the month before. Purchase indexes fell, which is pretty interesting. They've been driving it. Refinances are way up. I hear rates are low. Looks like 30-year rates are at their lowest point, 3.19%. And that's still not enough to drive any growth in the real estate lending market, which is not good. And we'll look at that, of course, on Friday. How about into the U.S. data? Now we get export prices. On on a year over year, on a month over month, the export and import prices both were up 1.4, big jumps. But how about on a year over year basis? Export prices went from minus 6.2 to minus 4.4. We're still exporting deflation. How about on the import prices went from minus 6.2 to minus 3.8? We're still exporting deflation. So anyone that's saying there's inflation going on is not showing up where it actually matters, and that is prices. Let's also take a look at industrial production. Big jump a month over month to 5.4%, but on a year over year, it's at minus 10.82. Here is a chart of industrial production. You can see recessions happen under these big drops. And so we'll move in a little bit. And on a year, you can see there's that pop. Now in the past, these signal a bottom. Now let's go to a year over year basis on this. And we'll zoom out. And you can see we're coming out of a recession, the shortest recession in history, or we're about to have a double dip recession and things are going to get really ugly. And that last time we saw that, 1931, Great Depression, double dip in industrial production. Yikes. Back to the data, manufacturing production, it also jumped from 3.8 to 7.2% on a month over month, still down on a year over year basis. Capacity utilization, another great proxy that tells if inflation is coming. And so capacity, now when we talk about capacity utilization, we're talking about factories, okay? So you own a factory. What percentage of your capacity are you running at? So when you think about it, if you're running low capacity, there's no inflation. There's no pricing pressure. Where do you get pricing pressure? When you start to fill up your capacity, because what do you have to do? Open another shift, pay overtime potentially. That's where you're getting inflation from utilization rates. So let's go look. This one from 65.1% to 68.6%, hitting the Fred charts. And you can just go look this up. You can either type in Fred capacity utilization or go to the website and use this code here, TCU. And you can see, when capacity utilization bottoms and rises, it's at the end of a recession. So it's telling us potentially, are we at the end of a recession or not? Unlikely. But from an inflationary standpoint, you want to see inflation, you need to see CAP-U get over 80%. And we got a long ways to go, my friends, long ways to go on that. All right, today, crude oil, again, coming off of a holiday week. We're still running pretty high levels of inventory, but the crude oil industry was very happy about this. Oil inventories fell about 7.5 million. We saw gasoline stocks drop 3.1 million. Distillate inventories dropped 453K. That's not a very big drop for distillates, by the way. Now, some of the things to factor, one, there was a holiday week here. Imports to the U.S. were oil imports were down 25% last week, so that's a pretty big number. And OPEC Plus is going to reduce their taper. I think it's around 2 million barrels a day-ish. So they're going to effectively increase production. Now, this is not new data. This was planned a long time ago, and they just agreed to do it. So these are negative factors, although OPEC said, we think there's demand there. We'll really see, because this is pretty much the peak season for driving and oil demand in this country, is in the summer. And as those summer weeks fade into school starting, whether it's people staying at home or going to the classroom, doesn't really matter. What matters is we have rather high inventory levels at a time when we seasonally shouldn't have high inventory levels. And what do we see in the oil stocks as well? We see the same thing, as they're looking like they're headed lower. Well, oil executives, they know. And that's a factor in here as well. So let's just kind of quickly see if there's anything interesting coming up that you can look for. On Thursday's data, there's more CPI data coming out. So you have the jobless claims and the Philly Fed data and retail sales coming up, and that should be pretty interesting. So keep an eye on that. All right, now let's see how we're doing on time. Perfect. Let's go and mosey through some charts and see what's going on in what the charts are telling us, because I think it's important to do macro with charts. So the S&P 500, again, it's fighting this upward trend line. The bulls need to keep this thing moving upwards, keep this trend line rising, because a breakdown of this trend line is not very good for them at all. Tech stocks, oddly enough, are not leading the way anymore. Russell 2000 had a huge jump today as the oil draws kind of gave some hope to small businesses, but don't hold your breath on that. But again, the small caps, they fell below their rising trend line, fought above it, and need to stay up there to keep the bullish narrative intact. How about volatility? And we saw sellers came in yesterday defending that 31 level, which I believe is very, very critical, and sold today. So now the VIX is sitting over its 200-day moving average and below its 50-day moving average. But again, that 31 level is critical. I think if you get a move up here, you see either a short pop, or the big risk is you blow through the March high in volatility. And so this comes back to my base case of there could be a big blow up in the markets, which I still think is priced in, and a rebound, because when volatility is just way too high, you'll get VIX sellers, and that's how you can get a bottom. So keep that in mind. The bigger the blow up in the VIX, the better potential there is for a bottom. How about the bond market? Is it telling you there's reflation? No, none at all. We take a look at the 30-year here, and sitting pretty much where it was back in early or mid and late March. No real change in yields there at all. And despite efforts to push yields higher, all we did see is the 30-year come bounce off of this support level here at 1.3% and really not find a whole lot of action there. 10-year yields are telling us nothing because the program's not updating all of a sudden. It's awesome. And yeah, great. So okay, here we go. Let's move on. Let's go back to 10-year. There it goes. 10-year Treasuries. Again, no sign of inflation. They're sitting bounced off of also support level of around 5.5 or 0.55%. No strength here from sellers at all. 5-year yields just teetering right on the edge of this line of doom, where this is just clearly a topping pattern there. How about energy stocks? They broke higher above their trend line over their 100-day moving average after finding support where we've seen previous levels of support. Again, we're looking at the largest energy ETF, which is mostly Chevron and Exxon Mobil. Exxon being the largest, Chevron being the second largest position. So you can look at this and get a feel for what the majors are doing. What I'm noticing here is a potential left shoulder head, right shoulder forming here. Be interesting to see if energy stocks get up maybe into this $38 level on this ETF. Same picture with financial stocks. They held their rising trend line, bounced up into the sell zone. How is the sell zone? Because we've seen sellers here. We have potential two left shoulders head and maybe now right shoulder forming in here. So it'll be interesting to see if they can get financial stocks higher at a point where we're seeing some dividend cuts and no share buybacks now from the big financials. How about that megaphone pattern on the S&P 500? Well, still intact, but remember, a break above this should send a big bullish signal. But so far, it is still not digging out of that, but it's still bullish at the moment. Moving into emerging markets, they're holding their upward trend line. Most of this, about 40% of this is China. Looks like a short-term topping pattern. Will it roll down and hold this, or will it continue to rise? I'm not convinced that we see this thing keep rising. I don't think the global economic data is that strong. But again, I'm looking for a big move down in EEM. How about our favorite, because this is the bond show after all, Bond, Steve Bond. What happened here? Well, I want to spend a little time talking about what's going on with what I dub the midnight sellers. So I've been trying to get the answer to this question, and it looks like it's coming out of the European market simply just by the time of night it's trading. And there's some view that the European market, as it's reopening, there's a demand for euros. So how does that translate to a bond sell-off? All right, well, let's say that you're in the Eurozone and the banks or whomever are holding U.S. Treasury securities and you have demand for euros. Well, how do you get them? You could sell your U.S. Treasury securities and get what? Not euros, dollars. And then what do? Sell your dollars to get euros. In that case, you have the euro rising, dollar falling. Does that make sense? It does. So let's dig a little deeper into what we're seeing here on the chart. We'll also take a look at the dollar. So we saw bond prices react pretty negatively in after hours trading yesterday due to more vaccine news, as if that's going to change the world all of a sudden. even if there is one, we saw a long road on that. Prices rebounded in overnight trading, and then it seems in the European market, sellers came in, right? I mean, the midnight sellers right on cue, and then bond prices opened up and moved higher, and then flirted with this roughly 1.3 level zone. Now, from a bullish narrative, I want to zoom back because this is a breakout of this triangle pattern here. We see it kind of broke the triangle, came back, retested it, broke up here, and it's almost forming another triangle. And now that I'm kind of looking at it, we should mark that up for fun because it's great to learn some of these charting things. And not that I'm the best and not even close. I will not admit that ever, but there's some basic charting things you can do. But look at the consistency. So this is the second highest point of this triangle pattern as it comes down. And this is usually the last point of when prices break through here. So I drew in this dashed purple line to say, look, this is where they were selling here. And then look, right, boom, sellers right at that same level. And sellers, right underneath it. And what is that telling you? From a charting standpoint, there are people that want to sell Treasury bonds at that price level. And they're not done yet. They might be done, but as far as we know at the moment, they're not done yet. And that's important to know because when they are done, or there's more buyers that push through the selling demand, then that kind of fulfills what happened back in this triangle pattern, where right in here, we saw sellers defending the second highest point, and then boom, 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 it moved right through the peak. Sellers did no stopping hardly there. Well, guess what? We're at that same point right here. Same point right here. Now let's zoom in and see. We do have a little triangle pattern, so let's draw that in just so you can see how someone who is not an expert at drawing things draws them. And the proper way would probably be to do something like that. So now we have something new to keep an eye on and see if we break up from this triangle. You could draw the bottom. Well, let's do it. You want it? All right. Well, let's draw it. Let's see. Maybe that's too far. Let's go and draw it from maybe back in here. So there you can see triangle pattern starting to build out there. So still bullish narrative, from the data is deflationary, but the chart's telling us something too. Now, if the charts were telling us something different, we would want to adjust our view, but the charts are confirming the bonds are about to break out, and that then sends us over to look at the dollar. It doesn't necessarily tell us what's going on in the dollar, but we want to see the dollar rally here, and now the dollar has dipped deep into that prior sell zone, and we can go and look at how low or how long the sell zone. This sell zone goes all the way back, or buy zone goes all the way back to 2015. So it's been here a while. So buyers have been buying the dollar around 96. So right at the moment, we look like we have a potential double bottom forming in the dollar. We'll see if that holds, but we want to see the dollar go up along with bond prices. So we'll see kind of how that plays out. And I suspect we'll see the dollar rally, but we'll see for sure. All right, so let's talk about the format change to the show. Now, I'm not a person to look at analytics. I don't do the show to make money because I don't really make that much money doing it. Now, maybe someday the show will have hundreds and hundreds of thousands of viewers per show. I have zero intention to, I don't have any goals for this. So it is what the show is, and I'm happy that all of you are here listening to it. So before we get into the Q&A, there's a change to the Q&A coming. And I looked at the video views from this weekend on the Q&A videos, and they're less than half of what a normal video view is getting. And what you don't see is it takes me about a half hour to film those. There's time to review the questions, prepare for the questions, and there's always in the after part. So for every 30 minutes of record time on a Q&A video, you're potentially seeing over an hour worth of things I've got to do. And on last Friday, with the Friday video, and those two videos are recorded for the weekend, well, there was a lot of time spent. And if people aren't going to watch them to the same extent as we're going to watch these videos, then I'm not going to invest my time in them. Now, that doesn't mean I'm not going to take questions anymore. We're just going to change how the questions are going to be done. I'm going to start tacking on approximately 10 minutes at the end of each video. So I'm normally trying to shoot for around a 30-minute mark. We're now going to look towards closer to 40 minutes, with the last 10 minutes being questions. I'm no longer going to answer every question that comes in. I'm going to look for questions that are on topic, questions that are good, that are actually something that I feel is relevant to what we're talking about or the direction where we're going with the macro data and the show. I want to focus on that. I will also prioritize people that have sent in good questions in the past. So if someone's I recognize as a good question asker, they're going to get priority over potentially someone else. I will no longer be double answering the same question in the same video. So if I see two people send a similar question, I will pick one and push the other one out. So you may not see your question answered, but you may see someone else ask it. I'm going to look for you when you submit a question to send me one or two good ones. Don't send me, some people like sending 4, 6, 8 questions and hoping I answer them all or pick here, or they'll say pick the one you like. Nope, I'm going to pick none. I'm challenging you in the show to think better and build your macro thesis. Now I'm going to challenge you to send better questions in, because I might not answer them. So I'm going to put them in a queue. If I don't get to them after a few weeks, they're gone. If you have a question I'm very interested in, but I'm not ready to talk about that yet, you'll linger there for a while. So don't send a question in, then because I didn't answer it, send it in the next. Don't do that, because I'm just going to delete it. So I'm going to try to make the question and answer section tighter, and we'll see how that goes. And if things change in the future, we need to bring back the Q&A and there's demand for that, I'll be open-minded to that if we get the video views. So on to the questions. So you can continue submitting questions as you normally do. Just know that I might, instead of replying, yes, I've added you to the list, you might get an answer on now. I will consider your questions, and they may or may not get answered. I don't know. All right, on to, and so my goal is going to be to try to answer as many as I can, just within the allotted 10 minutes I'm going to give myself. All right, so the first question is actually the answer from Chris Dark. We worked out the answer to the M2 last week. Now he's telling me that, yeah, hey, dummy, you forgot the answer, and he was right. M2 goes up when the Treasury spends the stimulus. That is absolutely correct, because it hits bank accounts. And the reserves in the TGA are transferred to the depository bank if wherever the stimulus money is being spent. This is when it enters the M2. So the TGA money is not in the M2. If banks, primary dealers, buy originally using their reserves, then this is M2 neutral, and the M2 increase comes from when spent by the Treasury. So the money used to buy treasuries by the primary dealers doesn't show up in the M2. Another question that comes up is, well, why don't we see the M2 drop at the auction? Got a factor is, half of these auctions are bought by foreigners. That money is not, the M2 does not track deposits in foreign central bank accounts. It doesn't. So it's not, all that money does not show up in the M2. There's more money out in the world than there is in the M2. Another question that came up from several people is there's no alternative or TINA. And the idea behind this question is, and I actually didn't bother putting the question into the Q&A. I'm just going to kind of tell you what the question is. As a challenge to my narrative and my view is, hey, dividend yields on stocks are higher than Treasury yields. So, isn't the Fed kind of forcing people into risk assets, which could support risk prices? Yeah, they are forcing people into risk assets. Big mistake. But the reality is there is an alternative. The bonds are an alternative. Treasury bonds since October 18 have outperformed the stock market. Go check. And since 1982, the long bond has outperformed the stock market. You can go check that too. It's a fact. So when we look at this chart, because this is saying the same thing, the percentage of S&P 500 stocks with dividend greater than 10-year Treasury yield was at the peak of the great financial crisis, peak of the EU debt crisis, peak of the China oil shock, and currently the peak of what they're calling the pandemic. So the reality of the question is that doesn't matter. What matters is deflation. Because if you buy a stock just for a dividend and the stock price goes down, okay, we'll just say the dividend doesn't change. What do you now have? An annuity, right? Because you've lost your money. You're just hoping the dividend check keeps coming in. But what happens when they cut the dividend? Then you should have bought an annuity. And that happens. Go look at General Electric stock. People bought a lot of GE stock for the dividend. And the stock price went down. They say, all right, well, okay, well, I don't like that, but hey, I got my dividend. And then they slashed the dividend down to nothing. Whoops. See, people forget that a dividend is a refund of profits. And in recessions, companies can and do cut dividends. So there is an alternative. People just want an excuse to buy stocks. One question I do have regarding Friday's Treasury auction: could the dealers have bought more than the $3.3 billion in 30-year bonds from the Treasury if they had wanted to? No. So this is actually, I think we're talking about this is the broad Treasury auction. Oh yeah, okay. So the answer, okay, now I thought we were talking about the QE auction for a second. Could the dealers have bought more than $3.3 billion in 30-year bonds from the Treasury if they wanted to? Yes, they can. It is an auction. They just have to bid the price to get more. So the primary dealers could buy all of them. They just got to be the high bidder. I actually don't know if they could buy all of them. As long as I think there's some rules about certain things do get carved out, but if you're the high bidder, you can buy pretty much what you want. It looks like a lot more bonds were tendered, 47 billion, than accepted. Right. So there were offers for 47 billion, and the auction was for 19 billion. Just wondering if the Fed needs were expected to be 10 billion. Why didn't they buy more? Well, the Fed put out there that we're going to auction 19 billion. They just had 47 billion worth of bids. I mean, look, there's always going to be somebody that's going to throw a low bid in, thinking they might win. You never know. So, no, the auction was for 19 billion, and that was it. Dear Professor Bond, it was nice to hear your investment thesis fully broken down in the recent videos and some political commentary thoughts about what is to come. Hey, you're welcome. Overall, your macro interpretation makes sense and is definitely evidence-based, data-driven. Absolutely. Everything I do is data-driven. That's what macro is. With that said, perhaps you can help explain or venture a guess as to why gold, equities, as well as long bonds are all up at the same time. All right, well, let's answer that, and we'll go to the next part of the question. Is you have people that are believing in inflation and risk assets, and you have people, and then you have on one side, right? So there's your gold and your equities. On the other side, who's buying the bonds? The Fed and large commercial banks and the smart money. So you can actually have action on both sides of the fence. One will be wrong. Just want to be on the right side of the fence when that day comes. I'm on the side of the fence with the Fed, which is funny because so many people think they're on the side of the fence with the Fed. The Fed ain't buying stocks. They're buying bonds. Silver, emerging markets are trending with them, but definitely has not made the same levels. No, and that should tell you quite a bit. Why is everything so green when the VIX is so high? Economic data is bad. And JP Morgan CEO, CFO say caution and uncertainty as keywords for the future. All right, so let's talk about the VIX. When the VIX is high, it's a knife that cuts both directions, or in Dr. Purple's case, a double-sided scalpel, which he'd be, I don't know, I don't have these scalpels. I'm sure if he had a double-sided one, he'd be very happy about that. And maybe they are, and I just don't know. So anyways, Dr. Purple. And he's more famous than he knows. Anyways, when volatility is high, it can move prices in both directions. So that's something a lot of people don't understand about volatility. Volatility is elevated. So when a buyer comes in, they're going to end up paying more than in a period when volatility is low. And by the same token, if someone comes in to sell, they might sell it lower. So right now you have bullish order flow, and you have volatility thanks to the Fed doing QE, which a lot of people don't get, that QE equals higher volatility. And so that helps push prices up. And you can look at the ticks during the day on, say, the SPY, the largest S&P 500 ETF, and you can see those pops. That's volatility. But remember, volatility cuts both ways. Well, why are the banks saying caution and uncertainty? Because they know. They know the data. They know more than we know. What are most buyers seeing that I'm not? Because TINA concept is not valid. That's correct, since bonds are the alternative. They are, and have clearly performed well in 2020. They've performed well in 2020, 2019. And in fact, they'll perform well, like I said before, since late 2018, October 2018, when they peaked, and going back all the way to 1982. All right, let's keep rolling. Hi, Steven. Thanks for answering my question before I've got one more for you. You're welcome. When the Fed does QE, the money stays in the commercial bank reserves account. Yep. Putting myself in the shoes of the bank, though, is it possible to think, hey, I've got all this money at the Fed that will cover my reserve requirements for lending, so I'm freed up to take cash I have, not all the Fed, and do other stuff with it. Yeah, they can do that. So yes, As a bank, I can't specifically touch the Fed account, but it fulfills the same purpose as cash I typically hold on to, which means I could use free cash to maybe buy stocks. No, banks are not using their money to buy stocks. They can use their money to buy their stocks back, although not right now because they're banned from that for the quarter. But no, they're not out, look, they're not out going out and buying Amazon and Facebook stocks. No. Thanks again. Really appreciate your videos. Hey, you're very, very welcome. And with that, we will wrap up today's video, and we'll see how this format goes for a while, and maybe it'll work out, maybe it won't. I'm always open to change as long as you're open to watching. Anyways, I'm Steve Van Metre. I'll see you on Friday for our deeper dive into the credit data, which should be very interesting, and we'll see if bonds break up from that triangle. The content of this video, why am I showing you that? I don't know. Is provided educational information only. Is not intended to provide investment or other advice. This trail is not to be construed as a recommendation or solicitation by participating in any particular trading strategy. To buy or sell a security, financial product, instrument, or to participate in particular trading strategies. This video was prepared by Steven Van Metre. Personal capacity opinions expressed in this video that anyone do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.